Welcome to Accounting Theory classes. I am Venkatmurthy SG, Assistant Professor of Commerce, Government First Grade College, Monkey. This is a revision session on measurement of asset and liabilities in the subject of accounting theory. Content of the sessions are as follows: meaning, definition, accounting concept and classification of assets, meaning and assumptions of measurement of assets, methods of measurement or valuation of assets, valuation of inventory, meaning and their systems, methods of pricing the material issue, liability, meaning, definition and classifications of liabilities, meaning of measurement of liabilities, definition and meaning of assets. According to the Institute of Chartered Accountants of India, the term asset refers to tangible objects or intangible rights owned by an enterprise and carrying probable future benefits. Asset is any resource owned by a business or any economic entity. It is anything tangible or intangible that can be owned or controlled to produce value and that is held by economic entity and that could produce positive economic value. Here, it's clear that asset is anything which can able to bring the future benefit for the company or entity which is held those assets. The accounting concepts of asset. Here, asset can be represented in equation form as follows: asset equals to outside liabilities plus shareholders fund. If we add all the outside liabilities to the shareholders fund, we will get the total value of asset held by the firm. The classification of assets. The assets can be classified into two broader categories. Those are non-current asset, which are also called as long-term assets. Second one is current assets, which are also called as short-term assets. Both non-current assets and current assets in sum creates total asset side of the balance sheet of any entity. Measurement of assets. Measurement or valuation of asset means expression of the value of assets in terms of money. Cash is the only acceptable or considerable unit of measurement of services or benefits in any business entity. Assumptions for measurement of assets. Number 1, assumption of continuity of business. Number 2, assumption of periodicity of the business. Number 3, assumption of historical cost. These are the three assumptions which are explained in earlier classes. They are the basis for measuring any assets in any business entity. Methods of measurement or valuation of assets. Following are the 5 different methods used for valuation or measuring the assets held by any business entity or any firm. They are as follows: A. Historical cost method. Under historical cost method, the value of the asset are evaluated at historical cost or acquired cost of the asset at the time of purchase. B. Replacement cost method. Under replacement cost method, the value of the asset determined at replacement value of the same asset from the market on the date of preparation of the balance sheet. Net realizable value method. Under this method, market value or cost price, whichever is less, or net realizable value or cost price, whichever is less, is considered as the cost price or the value of asset of the asset held by the company for the purpose of valuation of asset. Fourth one, or D, present value of expected cash flows method. Under present value of expected cash flows method, the future benefits which is which can earn by the asset are considered and discounted and compared with outflow of funds, and the total value of inflows are adjusted with total outflows and at present value, and the net value of the outflows and inflows are considered as present value of expected cash flows under this method. And this calculated expected cash flow is considered as value of asset under present value of expected cash flow method for valuation of asset. Fourth one, lower of cost or market rule method. Under this method, low cost price or market price, whichever is less, is considered for valuation of asset or value of asset. This method considers lower of cost or market price under principle of prudence. Valuation of inventory. Inventory valuation is the process of ascertaining the value of stock held with company at the end of the accounting period. It includes raw material, semi-finished goods, and unsold finished goods. System of valuation of inventory. There are two systems for valuation of inventory. They are namely, number one, periodic inventory system, second one, perpetual inventory system. In periodic inventory system, once in a particular period end, the inventory is valued and stock is measured for valuation of inventory. Under perpetual inventory system, the regular stock taking will be taken place and regular recording of inflow and outflow of inventory will be recorded at particular pricing methods. And here perpetual inventory system is acceptable for large scale operating firms and periodic inventory system is suitable for small scale industries. Methods of pricing the issues. There are four major methods or important methods for pricing the materials for issue purpose. They are as follows. A. First in, first out method, popularly called as FIFO method. Under FIFO method, all the materials issued at first will be issued to the production first. Second one, last in, first out method. It is also called as LIFO method. Under LIFO method, the material purchased lastly will be issued for first. So it is called as last in, first out. Number C or number 3, simple average price method. Under simple average price method, all the different prices held in the store are considered for determining the average price of different prices held in the stock for issuing the material or pricing the material for issue. Fourth one, weighted average price method. Under weighted average price method, all the number of units held in the store are considered to calculate average of the every unit held by the company. Under weighted average price method, whenever new purchase of material takes place, new weighted average price will be calculated for the pricing the material for issue. Meaning and definition of liability. Liabilities are the debt owned by the business entity to outsiders. Example, amount due to suppliers, bills payable, loan from bank, and unpaid expenses. Liabilities are obligations resulting from past transactions that require the firm to pay money, provide goods, or perform services in the future. According to Institute of Chartered Accountants of India, liability is the financial obligation of an enterprise other than owner's fund. Accounting concept of liability. In balance sheet or in accounting, we will represent liabilities in the following equation. That is, liability equals to asset minus shareholders fund. Here, shareholders fund will be deducted from the total assets so that to calculate liabilities of the firm. Classification of liability. The liabilities of the firm can be classified into four broader categories. They are as follows. A. Current liabilities, which are also called as short-term liabilities. B. Non-current liabilities. They are also called as long-term liabilities. C. Contingent liabilities. They are also called as the liabilities which may or may not happen in future. D. Capital or owner's equity. These are the funds which is belongs to the owners or shareholders of the firm. Measurement of liabilities. The measurement or valuation of liability is part of the process of measuring both capital and income of any business enterprise. It is important to measure liability to maintain capital and ascertainment of firm's financial position. According to Bolton, the requirement for an accurate measurement of the financial position and financial structure should determine the basis for liability valuation. Their valuation should be consistent with valuation of assets and are the resources used for the present session. Thank you.